Welcome everyone to this ICMA webinar on ESG ratings and data products, in which we will aim to take stock of where the market is, but also look a little bit ahead to the future. Before I dive into a discussion with my fellow panelists to do exactly that, let me set the scene a little bit and remind everyone what we're talking about. So in recent years, ratings and data product providers have come to play a major role in the sustainable finance ecosystem, with especially investors looking to them for major insights. At the same time, the diversity of products, methodologies, and business models has led to initiatives to ensure appropriate transparency, comparability, and reliability, as well as mitigate the potential for conflicts of interest and greenwashing risks. Taking note of these developments, IOSCO in November 2021 came out with 10 recommendations for regulators and market participants to improve governance, transparency and engagement, manage conflicts of interest, and secure product quality and confidentiality. Now, ICMA recently published a paper which provides an overview of the evolving landscape of ESG ratings and data products, examining the types of products and services offered, their use by market participants, and the regulatory and policy responses that have emerged in recent years. For the paper, we also conducted a survey among ICMA members, asset owners and asset managers, representing approximately $28 trillion in asset under management, to illustrate how ESG ratings and data products are used in practice today. Now, this is a busy slide. I'm not going to go into details, but the terms ESG ratings and ESG scores are often used interchangeably, and IOSCO in its 2021 report came up with terminology for ESG ratings, scores, and data. In short, we can say that ESG ratings include analyst judgment or an opinion, as it's often called, and scores are rules-based and algorithmic. ESG data includes raw and processed data, collected from public disclosures, questionnaires, and alternative sources, and increasingly this is powered by AI for efficiency. Data also include controversy reports and alerts, including norms-based research and screening. Controversy reports or alerts are considered as a data point when creating an ESG rating or score. However, when sold as a standalone product, they are likely to fall under the ESG rating definition in the UK and the EU, which we can hear about later. So as I said, we conducted a survey, and the respondents of our survey confirmed that they use both external and internal ESG ratings and scores, but their responses show differences in their use cases. External ratings are employed by the majority primarily to comply with investment mandates and for engagement purposes, while half of respondents consider them relevant for credit and risk analysis. Importantly, internal ratings and scores are used by an even larger majority for these purposes, but they prove to be more specifically relevant for compliance with regulatory requirements and for assessing double materiality. Especially the use for regulatory purposes is no surprise to anyone in the European context, looking at regulations for fund managers in both the EU and the UK. So as you will know, ICMA has a code of conduct. In fact, the FCA tasked both the ICMA and IRSG at the time, following the IOSCO recommendations, to convene a working group and work on a code of conduct. And both MSCI and BNP Paribas were also part of that working group. And this is an overview of what we have in terms of this voluntary guidance nowadays. So back then, Japan, the JFSA, was the first one to come out with the Code of Conduct 2022. That followed by Singapore, Monetary Authority of Singapore, or MAS, in December 2023. Just a few days later, ICMA came out with our Code of Conduct, which is now owned by ICMA. And then the Hong Kong SFC actually about a year later, adopted the ICMA principles. So the code is based on 6 principles, and endorsed it, which is why it's called the Hong Kong Code. So looking at those codes, they have been a real success, I would say. To this day, we have 29 signups for Japan. We have 13 for Singapore. 2 in brackets means that it's assured by a third party. The ICMA code, which is really an international code, so it's not a UK code or specific to any region. It's meant to be an international code, which probably explains why it has the most signups, 42. And the Hong Kong code, which is the ICMA code, has 21. So as I said, ICMA and Hong Kong is really the same code. Singapore is slightly different. The most different one is the Japanese one. And what they differ in all is the attestation document that comes with it. We have an endorsement for Japan. We have a self-attestation checklist and also the option to assure that from Singapore. We have a more free flow or freestyle application statement with the ICMA code. And Hong Kong decided to go for a stricter self-attestation document. Now, to help especially compliance departments with that, Hong Kong, Singapore, and ICMA came together and recently created an interoperable mapping reference. So this is something that you can find on the ICMA website. It's an interoperable mapping document. It's not an attestation document in itself, but it just gives a good comparison between the attestation and the principles for all 3 codes. But again, as I keep repeating, ICMA and Hong Kong are the same principles anyway. Then coming to regulation, while voluntary codes, of course, have materially improved transparency and governance practices, feedback from market participants in our survey as well indicated that many investors continue to view them as complementary to regulation, and they would still like to see a formal regulation in that space. So currently, in both the EU and the UK, we have efforts to regulate the market for ESG ratings, not yet for data products. That might come as well, and we're going to talk about that. But definitely, as you can see here on the slide, the EU is already out and it's going to apply from July 2026. I'm sure Malgorzata can tell us a little bit more about that. And then the UK, which Vanessa will tell us more about, is obviously underway, and a regime will come into place from 29th of June 2028. Now, just looking to the future a little bit more, in the paper, we also have some points for reflection. So voluntary codes and regulation can coexist. They will coexist for a while, especially for ESG data products and in jurisdictions where regulation is still evolving. As I said, the ICMA code is definitely an international code, so can be used in other locations and jurisdictions. It's going to be a continuing challenge for both voluntary codes of conduct and regulatory regimes on the interpretation of definitions relating to ESG ratings, scores, and data. We see in practice providers often face uncertainty when determining whether a particular product or service should be classified as a rating, a score, or data, and at what point it falls within scope. These difficulties are particularly pronounced in relation to ESG data products, which led the ICMA Code of Conduct to allow ESG data product providers for a longer implementation period than ESG rating providers. We see in the EU, the ESRS, and also internationally, the ISSB standards, which normally should have improved data availability, don't provide everything, especially in the EU. We now see a simplification in terms of the omnibus. So CSRD and CSTTT scope has really been reduced, and therefore we think this will increase reliance on ESG data providers. Transparency has improved, but difference in public versus disclosure to subscribers can be seen. So we see that providers put a lot more information into the public domain, but of course it's understandable that their subscribers will still be getting more information. So the question remains how much additional transparency regulation can really deliver over voluntary codes. We see there is still more need for enhanced communication between providers and rated entities, including timely correction of erroneous data. That remains an area for improvement. And I think some providers have a dedicated email address. I think MSCI is one of them. We also see that regulation may give rise to unintended consequences. So in the EU, the costs and structural requirements associated with the ESGR, as the regulation is referred to, including the need for a local presence, have led some providers to consider their geographic coverage. And similar effects have been observed in India, where regulatory changes prompted certain providers, as we know, to withdraw from that market. ESG ratings divergence is partly intentional. We see there are papers out there that talk about how they differ, how they are not as correlated as credit ratings, but really that also makes sense. That's interesting to investors, we think. Nevertheless, investors would like to see, while maybe not a convergence in ratings, maybe more of a convergence in some methodologies or rating scales. And then finally, there is, of course, also, we talked about internal ratings. We have seen in the review for SFDR, we have seen some points or requirements emerge for fund managers or asset managers as well. So that'll be an interesting space to watch as well. And with that, I'm going to finish with my introductory presentation, and we will start a discussion with my fellow panelists. So welcome to all of you again. And let me maybe start with you, Nicolas. On MSCI was part of the working group, as I mentioned earlier. It was actually your colleague, Neil, that participated. But maybe tell us a little bit of what's MSCI's view on the ICMA Code of Conduct today as an ESG ratings and data product provider.
Certainly, and thank you very much for inviting me to speak today and for convening this forum. I think it's a very good, timely point in time to discuss that. So maybe coming back to your questions, how do we see the ICMA Code? I think, first of all, as you already explained, but just to reiterate, yeah, we were part of this ICMA-led and FCA-convened industry working group. We supported the work of that because it helped really translate IOSCO recommendation into practical market standards for transparency, governance, conflict of interest management, and engagement. And we particularly liked and still like today that the ICMA Code's intention was and still is to be international, interoperable. And that is for a global companies such as MSCI really important. MSCI, we published our statement of application to the ICMA Code end of 2024 for all products that fall into the sustainable and climate product category and covers products such as our ESG ratings, climate value at risk, as well as implied temperature. So I think what really, coming back to the question, what do we really see has the code done? I think would I have to say three things. I think, first of all, transparency of methodology is now the norm. The code has global reach. And thirdly, it builds trust in nascent market. So maybe delving very briefly into these three aspects. So again, as said, the code really moved the market forward with this sixth principle, which calls for transparency of methodology, conflict of interest management, confidential safeguards, and constructive engagement with rated entities. So now across the market, public methodologies and formal conflict of interest management rules are the expected norm. And again, second point, the global reach, important as you already alluded to in your introduction. If you look to Hong Kong or Singapore, there is really voluntary interoperable codes which align with the IOSCO recommendation. And they show that a principle-based approach can scale across jurisdiction without the need for every market to pass legislation. And I think that is really where the ICMA code has been very, very helpful. Then importantly, also you already mentioned that in your very good summary, is that we think that the code is really good, especially for ESG data products or raw data, because it remains the code for these products remains the right tool because we believe regulation would be too prescriptive and would hamper innovation in this nascent market. So this tool allows, the code as a tool allows the market to foster, but in a more transparent way, and we really welcome that. And we think that ICMA and the code have played in that really the role bringing the market forward and translating again our IOSCO recommendation to common market practice.
Yeah, thank you. And we'll maybe just tell everyone in 1 or 2 sentences briefly what FoSDA is or what FoSDA does, because not everyone listening here or watching might be familiar with the organization. And then my first question to you would be similar to what MSCI just said. Do you see that from providers that you work with as well, that codes of conduct, especially the ICMA code, maybe has helped? Just tell us a little bit from FoSDA perspective.
No, thank you very much for the opportunity to participate in this interesting discussion. So the Future of Sustainable Data Alliance is a multi-member group that seeks to enable the power of financial markets to address global environmental and social challenges through the provision of comprehensive and high-quality data and analytics. And our members are drawn from the sustainability data, analytics, ratings, research, and index provision providers that work with investors, companies, and governments to help them achieve their sustainability goals. So just to make it clear, we're essentially an association, so we are not a firm, so we don't have at FoSDA ourselves direct experience of applying codes to ratings or data products, but our many members do, and clearly we have had the opportunity to discuss the role of codes with them. And I think, as Nicolas said, Simone, I think our members would agree with your observation that codes have been a real success. It has been a while now since we had the IOSCO recommendations, more than 5 years, or very nearly 5 years, and we've had the codes in place now for 2 to 3 years. And I think we've seen them adopted very broadly across the ecosystem, as you indicated in your earlier comments, 42 registrants for the ICMA code, and developing and monitoring an application statement to that code or to the different codes that in operation around the world is not a simple matter. While the codes probably do largely reflect existing practices within organization, they do require providers to codify those practices and then to ensure that they have operational reporting against those. You can find these reports online. They're really quite extensive. They're very detailed. And on occasion, they may just cover the ICMA code, or sometimes they may cover the ICMA code and the Japanese code or other codes. Many of the statements of application cover both ratings and data, with just a few, I think, covering data alone. And I think where there are individual applications relating to data products, feedback that we have from members is that the statement makes less sense than it does for an application with respect to ESG ratings. Really, the framework is designed primarily for ratings, and components of the code, such as conflicts of interest or engagement, seem to be less relevant to the world of data provision than they are perhaps to the world of ESG ratings. But they are structures that require organizations to draw together multiple processes, multiple sources of information, and then to monitor and to manage against those. And our sense is that they have changed behavior, and they are actually providing a reasonably high bar for the market.
Yeah, thank you. And indeed, that's probably why the ratings are covered in the first place with regulation, but data products not yet. But indeed, there might also be challenges in deciding whether a data product should be subject to a code of conduct. I've heard that numerous times as well, which, as I said, is why we've given data product providers more time to implement the code. But let me come to you, Stéphane. So you personally were a member of the working group that designed the ICMA Code of Conduct. And having just heard from the provider side, are you as a user of ESG ratings and data products happy with what has happened in recent years, leading to the current state of play? What else do you think is needed?
Okay, thanks for asking, Simone. Definitely, I think that, well, two steps. First of all, IOSCO's recommendations, plus following that, ICMA's Code of Conduct were very helpful in trying to improve both, on the one hand, the quality of external ESG ratings and data, and also, I would say, the transparency of such external provisions. So both in terms of quality or reliability and transparency on methodologies, I think that both IOSCO's recommendations and ICMA's Code of Conduct were very helpful at either local or international levels. In addition, from the ESG rating side, both the EU initiative under the legislative framework of the regulation, EU regulation, and the UK one, in both cases applicable to ESG ratings, are also a way to enhance and to secure even further the quality and transparency on the external ESG rating side. Still, we think that the Code of Conduct has been implemented in various ways, not in various ways, but in various jurisdictions, in fact, in Asia, as you reminded us, both you, Simone, as well as Nicolas. So indeed, in particular in Hong Kong and Singapore, and also Japanese had its own Code of Conduct. Surprisingly enough, regarding the EU, in spite of our suggestion to make the EU endorse ICMA's Code of Conduct, which would apply both to ESG ratings plus ESG data, it seems that, legally speaking, it's difficult for EU to endorse that Code of Conduct. And so we think that, at least from an EU perspective, there is still a missing piece regarding the ESG data which are provided by external providers. So maybe it will be a way to hear the view of the Commission in a few minutes on that. But definitely, we think that in order to secure, including in the EU, the quality and transparency of methodologies followed for ESG data, so this is the missing piece for the time being, and we hope that it will be solved soon.
Thank you very much. And yes, moving over to the official body, the EU. I mean, the EU hasn't indeed adopted the Code of Conduct, but it was the first jurisdiction to formally adopt a comprehensive regulation for ESG rating providers, and also introduce binding authorization and supervisory regime specifically for providers. But over to you, Malgorzata. Maybe tell us a little bit more about supervision will be centralized at the European Securities and Markets Authority, ESMA, and can you tell us about where we are with regulation at the moment?
Yes, good afternoon, everybody. So indeed, the regulation on ESG rating activities comes into application on 2nd July this year. So in 3 weeks, more or less. But maybe before stating where we are here, I would like to maybe take one step back and ask the question or explain what actually it means and who will be falling under the scope of a regulation. So, because this is very also important, we have heard that regulation will not apply to ESG data product. It's one of another product that will be not regulated will be not regulated and will be not under supervision of ESMA. But we need to also think who will be regulated. So ESG rating agencies established in the Union will be regulated in which cases? In cases when they issue or publish ESG ratings on their website, so they are publicly available, or in the cases when, even if they are not publicly available, they will be distributed to regulated financial undertakings or to European companies. But regulation will also apply to ESG rating providers established outside of the Union if they distribute their ESG ratings to regulated financial undertakings in the Union or to European companies. So it's not enough that the provider is established in the Union. It may be also the case when established outside of the Union, provider will also need to follow the regulation and will also subject to the supervision. And there is a long list of exemptions in the regulation. Why? Because the definition is pretty wide, pretty large. And one of the products excluded or from the list is indeed ESG data. The reason was that data, as we have heard, is even more difficult to define. There are different issues related to ESG data providers, maybe less conflict of interest. And the European co-legislator decided that they will start with ESG ratings, and ESG data, whether to include it under the scope or not, will be decided later under the revision. And the regulation provides for the revision within 4 years. So we will assess the application, we will assess the impact of a regulation, and there will be assessment whether it should be enlarged and the scope should be enlarged and include also data. But there are also other products which are excluded. For example, and I think it's interesting for the financial institutions, if financial institutions, financial undertakings, develop their own ESG ratings and use them for internal purposes or for in-house or intra-group financial services products, they are exempted. If financial institutions incorporate ESG rating in a regulated financial product or service and disclose it to a third party or disclose it to a user, they will be excluded from part of their requirements. So they are excluded from the requirements to be registered with ESMA and from the organizational requirements, but they are subject still to the transparency requirements. Why? The reason is if end users receive ESG rating, even if it's incorporated financial product or its accompanying financial product, they also should have the same access to information about this ESG rating. There should be level playing field as far as the transparency is concerned. There are many other exemptions. I don't think I will have time now to go through all of them. Maybe those who are, maybe I can list a few more. One of them would be external reviewers of your green bonds, external reviewers of second party opinions. On that issue, there will be also clarification via Q&A. There is also exemption from redistribution. So if ESG rating has been issued by authorized provider, if it's redistributed, it will not be, doesn't mean that if entity is redistributing ESG rating, but will be subject to the same requirements as providing it in the first place. Certain labels also excluded from the scope. So it's important to understand how the regulation was drafted. The definition is quite large and quite encompassing possible many products and services. That's why there is a number of exclusions. Now coming to where we are. So there are two important dates for the ESG rating provider, but also for users of ESG ratings, 2nd August and 2nd November. So you can imagine that there are many existing ESG rating providers, and it's impossible to have them all register authorized in one go, and there should be some way to ensure that there is a continuity in the operations. So ESG rating providers need to notify ESMA by 2nd of August, but they wish to continue operating in the EU Union, and then they have additional 4 months to apply for authorization. So that date is 2nd November. So after 2nd November, it's very important. If no application has been made to ESMA, then such a provider is not allowed to continue providing ESG ratings to European investors or to European companies. I would maybe try to share, because there is a very well explained, you can find very well this information explained on ESMA website, which shows the timeline and process for small providers and also for large providers. Why there's the difference for small providers? Because small providers can decide to use the temporary regime. It's Article 5 or temporary regime, and they have very less requirements that they need to comply with. And for that reason, they don't need to submit a full application. They only need to register with ESMA, and the supervision by ESMA will be also very limited, and the cost will be also much lower compared to the cost of full supervision. So this is a way to help small providers continue operating, to lower the burden for them from organizational point of view, but administrative point of view, but also from cost point of view. I'm sorry, I didn't manage to share my screen.
That is okay. That was a lot of information, and I think things like less of a burden, less cost, whatever, always sounds good to anyone, right? But we will share that link to the ESMA website in the recording as well, so people can look at that. Thank you very much. Let's hear from the UK now. Vanessa, the FCA has recently, or has really taken IOSCO's recommendations to heart, I would say, by, as I mentioned, first asking ICMA and IRSG in 2022 to convene a working group to draft a voluntary code of conduct, which has since become the international code, and now developing a regulation as well. How have the findings from your most recent user and provider survey informed your policy approach? And also, can you provide an overview on what you're trying to achieve in the policy intervention, and tell us where you are in the process?
Yes, absolutely. Thank you very much, Simone. It's a pleasure to join this webinar today. So yes, indeed, it's all systems go within the FCA. So late last year, our government finalized the regulatory framework for bringing ESG rating providers into the FCA's remit. So it's important to note that our government set the scope of the regulation, but it's the role of the FCA to design, develop, and implement the new rules that will actually apply to ESG rating providers. You mentioned the user and provider surveys. So in developing new rules, we always take quite a rigorous approach to gathering and analyzing data. And this is really to ensure that our rules are grounded in real-world insights and market practices. So as part of our recent consultation, we published a research note that summarized some of the findings from our surveys and the analysis that we conducted to shape our policy. Our survey indicated, as you can imagine, widespread use of ESG ratings. So we had approximately 5,400 UK financial services firms using externally produced ESG ratings. And we found that firms were spending a combined total of £622 million on data products that include ESG ratings, and that survey ran until over the course of 2024, so up until November 2024. We found that this remains a concentrated market, with half of users using ratings from 4 of the largest providers. And unsurprisingly, principal use cases covered guiding investment decisions, including pensions and retirement income. Ratings are used in marketing and reporting, and also for constructing benchmarks and indices. So how did this flow into the policy process? Well, the survey results confirmed that this is an incredibly innovative market with a wide breadth of products and business models. We therefore had to design rules that will allow for a certain level of flexibility and proportionality. And this is just to ensure that the rules are fit for purpose for a dynamic and growing market. The survey also supported the need for regulatory intervention that's really aligned to the policy pillars under the IOSCO recommendations and the Code of Conduct. So we built on that strong foundation, but really our aim is to improve transparency and trust in the ESG ratings market. We've tried to balance risk with proportionality, so risk management with proportionality, and this is always a challenging balance to strike, I think, in regulatory development. In terms of the design, we've proposed baseline rules under our standard FCA framework alongside tailored rules for ESG rating providers. So that's where you'll see the transparency requirements, which are really tailored to ESG rating providers. At the end of the day, what we would like to see is ratings users being able to make informed investment decisions with confidence, but also for rated companies to really better understand how they're being assessed. What we're not trying to do is tell the market what an ESG rating should measure. We're not looking to prescribe methodologies or to allow undue influence on ratings or the ratings process. So it's really about improving the integrity and transparency of the process and the information provided. Just a quick update on where we are now. Our consultation closed in March of this year, so we're now working through the valuable feedback that we received, and this is to finalize our rules. We're aiming to finalize our rules by the end of this year. Once the rules are finalized, we'll have a pre-application support period. So this is where firms, ESG rating providers, can come to us for support in preparing high-quality applications for the gateway. Firms can then start applying for authorizations from June 2027, and the regime, as you mentioned, will come into force in June 2028. From that point, any firms in scope of the regulation will need to be regulated by the FCA. We're busy finalizing the rules, but we're also thinking forward to implementation. I think it's really, really important that when we're designing the rules, we're thinking about how these are going to land in the market. So we're currently carrying out a pilot to test the supervisory information that we'll be asking firms to provide us when they are regulated. I think this is a good example of how we're working with industry in line with our broader strategy, and we're really grateful for the strong support we've had on this work. I think in terms of next steps, we will be communicating a lot more in terms of how firms can get in touch with us when the time is right to get in touch with us for pre-application support, as well as steps that firms can take to prepare for the authorizations gateway. So I'd say watch this space.
Yeah, and importantly, as we're all in Europe, how will the interaction with the EU regulation that we've just heard more about work?
Yeah, absolutely. This was really, really important for us to consider as we were designing our rules, which have not yet been finalized. But I guess as we know, the EU is slightly ahead of us in terms of finalizing their regulation and moving towards the application of those rules. We do appreciate that many firms are operating under a global matrix business model. So generally, we've sought to develop an approach that's internationally aligned. I think it's really helpful that both the EU and the UK rules draw heavily on the IOSCO recommendations. And I think there's a great alignment in terms of the outcomes that we're seeking to achieve with respect to transparency, reliability, and trustworthiness of the ESG ratings market. So our rules are based around the same core pillars, but this isn't to say they're precisely the same. We do believe that despite some differences in our proposed approach, the rules are broadly aligned. And what we did is through the consultation process, we've really encouraged firms to come back to us and provide us with feedback on any areas that may cause operational or implementation challenges to them. We've received some very good feedback on that, and we're considering it very, very carefully as we finalize the rules so that we can continue to support that alignment between the regulatory frameworks. And we're also continuing to engage with our EU counterparts. We're really keen to share lessons learned and learn from EU counterparts to provide for that alignment where possible.
Yeah, thank you. And that's great to hear, because one of the things when ICMA responds to consultations on behalf of our members is we always ask for, not to have fragmentation, to really have alignment between different jurisdictions. Let me come back to you, Stéphane. So we've just heard from regulators and official bodies. What are you hoping and expecting that regulations will bring in terms of further improvements to the ESG market? And also maybe more specifically, should regulation apply to the proprietary or internal ESG ratings created by asset managers used to market funds, for example? And just to give a background, what I'm referring to is on the one hand, we see that the EU ESG regulation introduces amendments to the SFDR, Sustainable Finance Disclosure Regulation, where financial undertakings develop and disclose their own ESG ratings to ensure that they disclose the same information as specialized ESG rating providers. And on the other hand, we have seen in the proposed review of SFDR itself, there's a new Article 12A setting out principles for financial market participants on the use of data and estimates for the purposes of this regulation, which requires formalized and documented methodologies to be provided to investors upon request on relevant data sources, methodologies, and assumptions underpinning the estimates they make. So what are your thoughts on all of this, and what are your hopes for regulation?
Okay, so many questions. So on the ESG rating side as such, definitely we consider that it's rightly balanced both on the EU and UK side. And as explained earlier, especially by Malgorzata, for those of players, including asset managers, which build proprietary ratings, if they are not embedded into external materials which are provided to end clients, so they remain purely proprietary and inside, and then it's out of the scope. Conversely, and we think it's very meaningful, part of the EU legislation, it was already mentioned, I think it's in the part 3 or annex 3, in fact, of the legislation in the EU. The disclosure requirements apply to asset managers if they embed their own ESG ratings within materials given or provided to external clients. So we think it's a right balance regarding ESG ratings from our perspective. When you mentioned SFDR review, it was your second point. Definitely at the last minute, if I may say so, there was a new article which was introduced, Article 12A, if I'm right, which in fact wants to regulate the use of ESG data by users of ESG data. We are not against minimum legislation or regulation regarding the use of ESG data provided by external providers to users, but we think that provision only targets the users and does not target at all the providers of such ESG data. So it's a bit weird, to be honest with you, and we consider that it should be more balanced by considering that if EU legislators or executive bodies want to tackle the point, it should be tackled from a dual perspective regarding the users, but also regarding the providers. And to be honest with you, I have a specific, as an example, I have a specific case in mind, which regards some external ESG data providers, not MSCI. So it does not create any conflict of interest in that call. But on green bonds, EU green bonds, we are a committed asset manager willing to invest in green bonds. Therefore, we need data regarding avoided greenhouse gas emissions by issuers, by corporates. So avoided emissions of greenhouse gas, GHG emissions by corporates. We have received information from 2 external providers, not MSCI, once again, but there are a few others. The data regarding a specific issuer on a specific issuance of a given bond, the data in terms of assessment of the avoided emissions are very diverse or different from one provider to another, sometimes by more than 20 times. The point is that, okay, for not regulating the methodology, but in the information we receive from the 2 providers, we are not able, in terms of information, to reconstruct the way they calculated their data that they sell to us. Because, by the way, it's not a free data. Huh? We pay for that. So when you have paid for receiving external data, that you receive a huge divergence in the outcome from 2 different providers, by a multiplication by more than 20 times from one data to another, depending on the provider. And if the methodologies are not clear enough to rebuild yourself the calculations done by the providers, there is an issue. Because at the end of the day, we don't want to be accused of greenwashing when investing in green bonds. But if the data we receive are so far away from one provider to another, and if the disclosed methodologies cannot allow us to recalculate and to understand how the outcome has been calculated by the providers, there is a huge issue here. That's why, to be honest with you, from an EU perspective, in that case for EU green bonds, we don't understand why the EU is so cautious, more than over-cautious, in not tackling the point regarding that at least better transparency of methodologies regarding ESG data external provision. This is a big issue, because otherwise we will be accused of greenwashing. While by definition, I think we are very sincere in willing to invest in true green bonds, but with such differences in calculations without transparency enough, it will not go to the right direction. So we need some regulatory action. I'm sorry to say that, but this is a fact. Huh? And if Malgorzata wants to receive our files, I'm happy to provide them, definitely.
Thank you very much. And I can see this is a very important point to you and probably other users of ratings. Maybe on the specific greenhouse gas emissions of issuers, it would also help for issuers to report them, so we don't have to rely on estimates or calculations from third-party providers. But that is another topic. Let me come to you, Nicolas. What upcoming regulatory changes are you as MSCI looking out for? And maybe more specifically, what's your view on the EU ESG rating providers regulation?
Yeah, thank you. So first of all, thanks for the question. I'm going to get to it, but just want to maybe just very quickly react to what Stéphane has said. So I definitely he is concerned, and I share those, but I think it points to one important thing, and you mentioned that, Simone. It's the source of information, and the source of the information are corporate disclosures. And I think we should not forget that. And the importance is to focus on improving the quality of data sources. And so regulation of the intermittent value chain will not change it, which is obviously important. And I'll agree with that, is that if estimates are produced, that it's clear from third-party providers like ourselves or by anybody else used to inform investments decision, I think it's important that it's clear that estimates have been used and that it's clear how these estimates, there's a methodology around that. And we think this should be made available, be it from a third-party provider ourselves, or as well as anybody in-house. And we think, so to say, what the Commission did in the SFDR proposal in the Article 12A, this is precisely saying, in the absence of reported data, estimates can be used. It is just that if you use estimates, you need to be transparent around it. And very important, I just wanted to reiterate, at least from a MSCI perspective, this article and being transparent about how our estimates are constructed and the methodologies around them. We are supportive of that, and we will provide the necessary information to our clients. And so we don't think that there's any gaps, because precisely in order in the future to be able to use estimates, there will be an obligation of the third-party provider to provide them to users. So just that is. Then maybe coming back to your question around what are we looking forward to, and I think Malgorzata already highlighted that, is indeed the entry into force, or the application, better said, of the EU ESG rating providers regulation. MSCI intends to apply for authorization with ESMA to operate as an EU-regulated ESG rating provider once that becomes possible very soon. And I think it's important to remind ourselves, why is that such an important step? Why? I mean, it is threefold. It is you have the IOSCO recommendation, are transformed into EU law, because this is how the EU operates. We understand there's certain limitation around the using of an ICMA code. So obviously we have ICMA international, but the EU is its own jurisdiction and have the right to choose the legal tool that is most suited for that case. So that. We also think that the scope of regulation is the right one, and that it focuses on ESG rating, ESG score, but not ESG raw data. And we also welcome that the EU recognized the global context in which it is operating. And just very briefly on all these points, starting again with the transposition of the IOSCO recommendation is, again, it is moving from IOSCO, having the code of ICMA, now moving into that in the EU, being more transparent about what is actually the ESG rating measures. So making clear, are we talking about ESG rating that look at financial materiality, or are we looking at ESG rating of double materiality? So these type of codification around transparency, we think is very, very useful. And very useful as well is that the EU explicitly recognized that ESG rating constitutes opinions and that they're not labeled, and thereby enshrining the principle of methodology independence in law. Because this really, we believe, that safeguards the ability of ESG rating provider to develop methodologies independently within consultation of the market, but that respond to the need of the investor, because again, it is an investor-driven market mainly. And so transparency, independence of methodology paired with promoting transparency is for us really the right approach. Coming quickly back to the scope of the regulation, while in the title it only says ESG ratings, the scope is much larger. The scope also includes ESG scores. And so just again, for MSCI perspective, we have assessed that we have at least 8 product categories that will fall into the scope of this regulation. And we really remain convinced of that the exclusion of raw ESG data from the scope for now is the right decision to allow for the market to continue to evolve. Also, I would like to remind everybody, companies that operate in the EU also have, not all, but like we have signed up to the ICMA code. So it is not that there is nothing in the existence or in the absence of so. So ICMA is there as a code provider as well, because MSCI, we run a global business. We have global programs to adhere to regulation. So this is really also, fills, if there should be a gap, it is already being filled by ICMA. And then coming really very quickly back to the EU in a global context, we think it's good that the EU recognizes that. As we move into that, the UK is moving also in approach and regulation. The UK is recognizing that we live in a world where multiple jurisdictions have different types of rules and regulation, and some work with codes. And it's from a provider perspective, and we think also from a user perspective, important that these tools or these frameworks talk to each other and remain interoperable as much as possible to avoid duplicative or conflicting compliance burden.
Thank you very much, Nicolas, and you touched on a lot of important points, and also thank you for pointing out the difference between financial and or single and double materiality, which we found in our survey is increasingly important to investors and users in general. Will, you represent more providers. What do providers think about the EU's more prescriptive approach versus the UK seemingly planning to be more flexible to enable innovation while enhancing trust in ESG ratings? And also the future of Sustainable Data Alliance. What impact does AI have on the work of ESG ratings and data product providers?
Yeah, no, thank you very much. Both really interesting questions, but I wouldn't mind just very briefly going back to Nicolas's point, and I'd just like to emphasize that this is an ecosystem that continues to evolve quite quickly. If we think about the way in which the market has matured over the last 5 years, we're really seeing quite significant progression quite quickly, and I suspect that AI will contribute to that. Yes, it is an extremely competitive market. If we look at the fields of physical climate risk or nature risk, nature data, there are lots of different sources of data, some of them publicly available, some available from specialist providers, independent providers, many of them based in Europe, and also from our member firms who offer those services to our clients. So there is quite a lot of choice. And, I think where users experience disappointment, there are alternatives that they may find that may be able to provide them with the services that they're seeking. And just on sort of regulating data, I think that's going to be extremely challenging. We're talking about environmental, social, and governance data. That's a pretty big field, spanning quantitative metrics like, as Stéphane said, greenhouse gas emissions, energy use, water withdrawals, workplace safety rates, board level structures, and across to things like geospatial data sets, such as flood risk maps, heat stress projections, biodiversity sensitive areas, and given the relevance of multiple data sets, I think it would be very difficult to separate specific strands of sustainability related data that don't overlap with other data sets, including financial disclosures, corporate data, news, and other statistics. And so given the difficulty of establishing an effective regulatory perimeter, you'd almost be asking anyone who collects and distributes any information to register. And then you'd have to design a supervisory and enforcement approach to manage that. And I think that would be tricky. But to come back to your question on prescription versus flexibility, I think it's sometimes a little simplistic to characterize the EU and UK's approaches as prescriptive versus principles-based. You can argue that I think the UK approach lays down a set of clear high-level rules, but then allows flexibility within that, whereas the UK's approach is perhaps more principles-based, but then in its own way might be more far-reaching. So we're getting towards the time when we will be able to see how providers are implementing the new EU regime, and indeed the extent to which they choose whether to do so. But the UK regime is still under development, so it's perhaps a little bit too soon to have a clear view on the sort of relative effectiveness. But it does seem to me that the market is evolving positively. I think that the codes that we have seen working over these last few years have contributed to that positive evolution, and we're interested to see how regulation of ratings supports that in time. You asked about AI, and I think it's unquestionable that AI is going to accelerate the demand for comprehensive, comparable, high-quality data. We believe that it'll be important that data is structured, provided in defined, standardized ways, so that the power of AI can be most effectively brought to bear. And that's why we're looking closely at the issue of interoperability across data formats and reporting standards and taxonomies. All those parts of the sustainable data infrastructure are going to need to work well together if the potential benefits of AI are going to be realized, and indeed some of the potential challenges of AI perhaps going to be avoided.
Yeah, thank you very much. And as I mentioned, we found that AI indeed is already used by providers to go through the vast amount of data collected, right? But then interestingly, we hear so much in the press about AI replacing human beings. You still need an analyst at the end of the day to make sense of the data and to really just qualify that, which I'm sure users will appreciate. Vanessa, as the upcoming regulation only covers ESG ratings, the FCA has already endorsed the continued use of the ICMA Code of Conduct for ESG data products. Why do you think ESG data products can be continued to be covered by voluntary codes?
Thanks very much, Simone. So I guess, yeah, as you articulated, in setting the scope of the regulation, our government deliberately chose to limit this to ESG ratings. So they've excluded the provision of ESG data from the regulatory perimeter. I think it's important to note that the line between ESG ratings and data is not necessarily clear cut. So we've heard from firms that they can find it challenging to assess which products are in and out of scope of the regulation. To support firms with this, we're actually also consulting on perimeter guidance. So this is essentially guidance that is intended to help firms in interpreting the scope of the regulation. So we have received feedback on that perimeter guidance as well. And just to kind of come in on some of the concerns that panelists have raised with respect to the quality and availability of ESG data, we do share those concerns, and we hope that by regulating ESG ratings, this will result in downstream improvements in the quality, transparency, and availability of the ESG data that often underpins the ratings. And we're also doing more policy work on sustainability corporate disclosures. So, for example, we're consulting on how to align listed firms' disclosures with the UK version of ISSB. So I think it's worth looking at the ecosystem as a whole when considering some of the risks around ESG data. And we're very keen to support industry-led initiatives that will strengthen the ESG data market. So this includes the Code of Conduct, of course. We think this is a really useful bridge and complement to regulation. So, developing a regulatory regime takes time. So the ESG ratings regulation will be coming into force in the middle of 2028, whereas the Code of Conduct can help raise standards immediately. And we do think it's important that the code continues to cover products and providers that will sit outside of the regulatory perimeter. So ESG data providers should, continue to consider whether they will sign up and adhere to the code. We're very supportive of that.
Thank you. And obviously we're agreeing on that. So pleased to be of continued support on this. And please also for everyone, go to the ICMA website where we are, of course, where you can see who has signed up to the ICMA code, but we're also hosting the Hong Kong code and the Singapore code as well. So you can see the signups there. And maybe last question to you, Malgorzata. We've already heard a little bit from Nicolas and Will about the ESG acronym. Really, it's just such a short acronym, but it contains so many different things, from environmental to social to governance aspects. And then also Nicolas touched a bit on the double materiality. There are two notable proposals in the EU regulation. One is the breakdown of ESG ratings into E, S, and G, and also the double materiality approach. Can you give us a bit more insight into the importance of these elements?
Yes, thank you very much. Maybe before going doing that, I quickly respond to Stéphane comments about SFDR. I mean, we need to remember that SFDR is still, changes to SFDR are still under negotiation. So I think it's a bit too premature to discuss what will be outcome and what will be the requirements, on the usage of ESG data. So we need to take that into account. And also we need to remember that the decisions are taken by co-legislators. It's not the Commission who is taking the decision. It's Council and Parliament. It's easy to point out always at the Commission that is, faulty to do not do this, not to do that. But it's Member States and Parliament who finally take the decisions. It's on the Commission. And there is a revision clause in ESG rating regulation, and Commission will come up with a report on the impact and scope, and with a proposal of if necessary proposal to extend the scope of ESG rating regulation. So we are aware of concerns of the market. We hear them. We are listening to both sides, because both sides have different concerns, and the Commission we're trying to find a way forward. But there are also other institutions involved, and this Council and Parliament. So it's not only the Commission, but should be always blamed. And then, if to your question about the transparency requirements, so we need to remember that the aim of a regulation on ESG rating activities, which is actually ESG rating, is actually we're using the acronym, but actually it covers also scores. So it's not only opinions, but also scores. It's the integrity and transparency of those products, but also independence of ESG rating activities is very, very important. It was already mentioned, but it's a key principle of a regulation. So ESG rating providers have independence in the rating activities, and they have also independence of choosing the methodologies. There is a requirement that methodologies need to be rigorous, systematic, and there needs to be a sufficient transparency on the methodologies, and also what actually ratings or scores, because we use the term rating, but actually it applies also, but all the requirements apply also to scores. What are they actually assessing? So what you mentioned, those two important provisions are related to transparency requirements. So the regulation doesn't intervene into methodologies, doesn't prescribe how rating should be done. It says that there has to be clear information about what is the objective of a rating or a score, whether this rating or score is assessing risk, impacts, or both. If it's using double materiality principle, it has to be clearly explained, or if it's using any other dimension. And in the case of a double materiality, the proportion of risk and big impact materiality in the overall score. And then the regulation goes further, saying if you have, we could say, aggregated rating, so this is covering a number of factors, environmental, social, governance factors. Quite often it's not sufficient to have this aggregated rating. It has to be break down into ESG, meaning the transparency needs to be provided, what is covered within ESG, and also what is the weighting of those factors in this aggregated final score. And also in addition to that, explanation of a weighting method per different factors, and within ESG factors, specification of topics of covered, and whether those topics also correspond to the sustainability reporting information. So the regulation itself is not intervening, it's not prescribing how providers carry their assessment. It requires there is a clear information, there is transparency, there is no mistaken information, and there's in the case of aggregated ESG ratings, which probably are at least clear for users, there is clarity what is under those aggregated ESG ratings and how they have been aggregated, which is also important, because if you have a final one score, how much it includes E, S, and G in the overall score. So that's in a nutshell, because I think we are a bit running out of the time, and happy to answer any follow-up questions. Thank you.
Thank you very much. And indeed, we are at the end of the webinar, but I would also like to point out, especially on this, deriving at scores, and then from that we know that providers use scores to develop or to calculate or maybe calibrate rather ratings. You can have a look at the ESG ratings paper that ICMA published on the 12th of March, because there in the annex we actually made the effort of having a comparison of different providers' methodologies. So please have a look. We will also add a link to the paper with the recording. For now, I'd like to thank Malgorzata, Vanessa, Stéphane, Nicolas, and Will. Indeed, it is an evolving landscape, as we called our paper, and I'm very much looking forward to catching up with all of you once we have perhaps the EU and UK regulation more in place or finally adopted, and we'll see where the codes of conduct go. Maybe other regulations are developing codes as well. So an interesting space to watch. Thank you very much, and thank you to the audience as well. Thank you. Bye-bye.
Thank you.
Thank you.